welcome to BloombergQuint. We got the read on Q2 GDP data this week, and the read has been fairly decent, 8.4% GDP growth, perhaps a little bit ahead of consensus. What is important to try and understand is what the underlying trends there are and what message we're getting about the economy. Well, Pranjul Bhandari, Chief India Economist at HSBC, is joining us to help us analyze the numbers, but also give us a big picture on the economy. Pranjul, as always, thank you very much for taking the time.
Great to be here, Ira. Thank you for having me.
Pranjul, I'll start with the numbers and then we'll broaden it out. So what did you read into the numbers beyond the headline? What does it tell us about the state of consumption in the economy, government-led capex, if not private investment yet? And also, what trends you took away from the export side, which may be sort of boosting or giving the economy a bit of a boost right now?
Yeah, so look, 8.4% GDP growth, I think it's a good number. We were expecting 8.2, not very far off, but I think it's a good number. And some of the trends that stood out for me, the number one biggest positive trend was the return of personal services. Now, it's not very clear in the data at first glance, but hidden away in the GVA, there's a component called public and community services. But if you expand it, it's actually public, community, and personal services. And that is a sector which grew 17.4%, very high in real terms. We know that government consumption did not grow that much. So basically, I think that whole growth came from personal services. Things like your standard high touch, haircuts, restaurants, all of that came back. And on the GDP expenditure side, that actually lifted private consumption. Private consumption was 93% of pre-pandemic levels in the June quarter. It has now gone back to practically 100% of pre-pandemic levels in September. So it's been the return of personal services that has been most encouraging. The second encouraging thing was exports. It's not new. It's running about 23 to 25% higher than pre-pandemic levels. And if you peer into it closely, you see that a lot of it is being done by high-skill exports. Now we see exports are rising across the board, mobile phone handsets to drugs and pharma, auto parts, IT services, some select machinery. In fact, I would argue that this increase predates the pandemic. We're doing something right in high-skill exports, and that has been showing up in the data. The third positive, of course, is government capex. The fact that government capex is almost growing 50% year on year in that particular quarter. And although government capex is only a small part of overall investment, it's about only 25%, but running at such a high clip really lifts the entire sector. So I would say these three are the biggest positives that I took away. Of course, there are a few things I worry about, but we can get to that.
Getting to that in a minute. But your point on consumption is very interesting. So a lot of economists read into the overall consumption number on the expenditure side to say that that's still the relatively weak spot in the economy. Is there a distinction to be made in goods versus services, or at the aggregate, what do we take away on consumption?
I'm glad you brought that up. And there's definitely a distinction to be made between goods and services. Now, what we had before the personal services returned was pent-up goods demand. We know that through the pandemic, there has been a rise in income inequality. The rich have gotten richer and the rich are spending. We were hoping that as the rich spend on goods particularly, it trickles down to the bottom of the pyramid. Unfortunately, that was not very clear. And the reason it has not been very clear is that while the rich have been spending, and you look at the Diwali retail sales, they are big numbers, they have been spending a lot on imported goods. So look at consumer durables. Domestic production of consumer durables is 6% below pre-pandemic levels still, while the imports of the same consumer durables is 32% above pre-pandemic levels. So the rich have been spending on goods, but they have been spending more so on imported goods. And therefore, the trickle down to the bottom of the pyramid so far has been weak. That is looking back. But looking forward, now that we are seeing a pivot from goods to services demand, my sense is that the whole trickle down will be stronger for services. The reason being that many of these services are domestically produced. Think health, education, domestic travel, going to hotels, restaurants, cinemas. And my sense is that once the pivot becomes strong, then the trickle down will be stronger. And the pivot is something we noticed, very starkly in the GDP data yesterday that yes, a pivot from goods to services is happening. So just to sort of summarize, when we were only focusing on pent-up goods demand, when our vaccination rates were low, we were not looking at high-touch services, then the trickle down was weak. It was bad for income inequality. But now that we are doing a pivot from goods to services, my hope is that the trickle down picks up. And my sense is that the next 2 quarters will be a function of this.
Okay, just a couple of follow-up questions. So this import component that you're talking about, this is sort of goods like mobile phones, electronics. Is that the category where we are seeing much of this?
Yes, a lot of white goods. So,
Okay.
your standard televisions, washing machines, and so on, textiles, and so on and so forth. Basically, consumer goods, furniture.
Okay. And on services, the other part is that, on goods, you could say that some of this is pent up and, demand, which may not come back every quarter. But on services, the dynamic is entirely different, right? I mean, once the restaurants have opened, you will go out X number of times a month, a week, or whatever, depending on how social you are, I guess. So that then becomes a steady trickle unless there are restrictions again.
Well, look, you're right that, you won't buy more than one washing machine. So goods demand sort of comes back once and then it goes away, the pent-up demand. But I would argue something similar happens to pent-up services too. Like, for a standard family who's not taken a holiday for 2 years, maybe as soon as you can, you take a couple of holidays, but then you don't take a holiday all the time. As in, at some point, pent-up demand by definition ends. Both goods and services. You can argue that pent-up services demand lingers for longer, but at some point it has to have an end date. And that's why if I sort of try to tie this into how GDP is going to look, my sense is that the next 2 quarters will look pretty good because of this entire pent-up services demand playing through. And I think FY22 GDP growth will be strong. But the big question is, at some point, when we are done with pent-up goods and services demand, then what really drives GDP growth? And that's the big question. What drives growth in FY23 and FY24?
Let me bring in the issue of scars then. I think, you in your report, you juxtapose scars versus stars. On the scar side, is there, obviously there is still scarring from an income perspective, particularly perhaps, maybe from a rural income perspective. What's the latest data indicating to you?
Yeah, so I'm glad you brought up rural because a lot of things are happening there. It's very dynamic. Over the last year, it was a source of stability because rural India was not really under the crutches of the lockdown. Monsoon rains were good. Food trade was up and running, so it was a source of stability. But since around May this year, rural demand has slowed, quite a lot, and some of the big consumer companies have also spoken about it. And when you peer in, there are a lot of things that are driving it. Number one, volatile rains. They were normal, but they were still very volatile. Construction activity was a bit weaker because of volatile rains. Rural inflation has been rising since May, so that's hurting purchasing power. And also things like Narega. Narega is running 11% lower than last year. It's still higher than pre-pandemic, but it's much lower than last year. So all of this has hurt rural demand, in my view. But again, 2 things could improve rural fortunes in the next couple of months. Number one, if we sort of move from goods to services where trickle down is higher, that the one we've spoken about, that's one. And the second, if, now that the monsoon season is over, construction picks back up, if there is a big demand for residential real estate, a lot of people wanting to improve their houses after being locked in for 2 years, that could also increase the demand for commuting rural laborers. And that could be another source of, income for rural India. So, hoping that things pick up on that front. So that's rural. But really looking across all of this and thinking about 2-3 years down the line, I think, the fact that the rich have gotten richer, big companies have gotten bigger, all of that is likely to leave behind a scar. Now, we find that 80% of India's labor force is informal, and about half of them are people who don't work in agriculture. So they work in other sectors in rural and urban India. These are the people who, through the pandemic, have lost incomes, have lost jobs, have had to sell assets. They are sort of subdued right now. But if over time their demand continues to remain weak, then that will actually hurt growth. That will hurt the fortunes of even the big companies. And that is something which doesn't play out in the year of the slowdown, in the year of forced formalization. that's something that plays out over time. We saw the same thing during demonetization. In the year of demonetization, GDP growth was extremely strong. Everybody was thinking about it being a big reform. Stock markets were up. But the couple of years after demonetization, every single year GDP growth was lower. My sense is that the scar of rising inequality and disruption to the informal sector is something we will see more of over the next couple of years. It's not visible in the period of pent-up goods and services demand.
That's an important point. Pranjul, let me just shift focus a little bit to the capex side. Strong growth led by the government support, presumably. And if you look at the fiscal numbers, it does look like they can keep that going for the remainder of the year.
Well, yes, they have the fiscal buffer, and they can keep some of the capex on. Also, the hope is that state capex picks up at some point. At the end of the day, the central government has paid the states, a bit in advance, so the states have the money. With energy prices going up, oil prices going up, the VAT tax collection of states have also improved. So hopefully, even the states do some capex. But taking a step back, public capex only makes up 25% of the entire investment pie. At some point, you really need the 75%, which is the private sector, to come back in. And here, my sense is that the private sector has not really come back in big force. Of course, there are a few commodity sectors where capex is happening, but I don't think private capex is a big macro story yet. In the past, we found a couple of drivers of private capex. One of them was policy certainty. I think, we have that to a large extent right now, especially the budgets of the last 2 years focused on stability. I think that's a good thing. The second is the health of balance sheets. I think that's something which has also improved through the pandemic. A lot of deleveraging has happened. And the third thing is forecast of future GDP growth. And I think that's the sticking point. I think that's where there is a lot of uncertainty. People are not sure how to forecast GDP, 2 to 3 years down the line. And I think that is something which is keeping private sector capex a little weak.
That's very interesting, because a common refrain is that, like you said, the balance sheet cleanup to some extent or to a large extent has happened. Rates are low to the extent that rates play into, investment decisions. The uncertainty here is perhaps how quickly that consumption element continues to grow, capacity utilization improves. Is this a 12, 18-month story to your view, or is there no certainty over what time frame this could play out for?
Yeah, look, I hate to sound like a broken record, but eventually, once the whole pent-up goods and services, goods demand, all of that is done, after all of that is over, growth, as always, will be a function of effective reforms that the government undertakes. We are a country that has been producing below our production possibility frontier for a long time. In fact, you can argue for many decades. We need some important reforms to happen for us to go back into the production possibility frontier. And I think eventually that's going to be the big driver of GDP growth, 3 to 5 years down the line. Now, what is encouraging there is that through the pandemic, it seems that the government has tried to pursue reforms. They didn't put a pause button on reforms, which, it could have done. It was at the end of the day a huge crisis in the economy. And I think there are 3 reforms that I'm watching carefully. One is how the entire asset monetization plays out. I think that's a very important fiscal reform. It will enable the government to do a lot of capex going ahead, which is important to crowd in private investment. The second reform is the PLI. It worked out for mobile handsets. Let's see if it works out for some of the other sectors. And the third is, financial sector reforms, the combination of the bad bank, the insolvency and bankruptcy code now running. Let's see how effective these are. In the past, we've seen that many of these reforms are announced and they sort of are not very effectively implemented. I'm hoping it's different this time. My sense is that even if we get about 30 to 40% success in these reforms, I think we'll see potential growth rising back up after the pandemic. But a lot depends on the reform muscle of the government.
You had an earlier report, Pranjul, where you sort of focused on all of this capital coming into the startup space, etc. A little bit of a bright spark there, but in the aggregate, perhaps not as significant as some of the other factors we've spoken about.
Yeah, so look, I think digital startups, tech startups are a good thing. They are attracting a lot of money between 2015 and 2021, about $80 billion of inflows. Right now, we see that 50% of FDI inflows into the economy is digital. Till a few years ago, it was only 20%. So it's obviously getting a lot of money in. I also think it's good for the entrepreneurial culture. Which can be an important secret source of growth going forward. It does create jobs. It does create some capex, tangible, intangible. So I think generally good. The problem is twofold. Number one, it's still not mainstream economy. It's a fast growing sector, but it's still on the fringes. It can't move the needle, very aggressively. So it's still very small. And number two, a slightly different point, is that eventually the digital economy will reach its potential if the physical economy also rises. Because think of a standard e-commerce company. They sell products that the manufacturing sector will produce. They use the same, roads, ports, railways to transport these goods, that they sell. So if at some point, if manufacturing and investment doesn't rise in tandem, then the digital economy will face constraints of growth. Of course, it's not today, but down the line, that could become an important constraint for the digital economy.
Fair enough. Pranjul, let me just return to slightly more near-term issues. So Q3, given the festive season, etc., would be reasonably good. I'm not sure how we can even sort of understand what this new variant will do to the economy, but perhaps the best benchmark to say is that even in the second wave, the hit to the economy was much lower. But is there any sort of early thoughts on how this is going to playing out?
Yes, so huge amount of uncertainties out there. My sense is that a lot of it depends on lockdowns and restrictions. If local lockdowns and restrictions come back in a big way, of course it will hurt recovery. And I think that's the part we'll have to watch most carefully. How does what is the government stance on this entire new variant? The other part is trade. What if globally there's a problem and exports go down? My sense is that net trade may not be the biggest drag on growth if this variant turns out to be lethal, for the simple reason that even if exports go down, we are already seeing commodity prices collapse. Oil is down 12 to 14%. Some of our imports may also go down in line. So I don't see net trade as being a huge dampener for recovery. I think local lockdowns could be a bigger dampener if they come by.
The other issue, of course, would be what they do to the process of monetary policy normalization globally and locally. I mean, just overnight, we saw Fed Chief Powell finally sort of say that maybe it's time to retire the word transitory. I think inflation concerns are sort of taking hold globally. Domestically, today, we saw the PMI numbers pointing to very strong input price pressures, if not output prices yet. So one would have assumed before this that the process of normalization is accelerating or at least moving along what we would have expected. Is that still the base case scenario?
Well, look, yes. I think elevated inflation is here to stay. I'm not talking about runaway inflation. I'm not talking about 6 to 9% inflation, but elevated inflation. The fact that through the pandemic, core inflation has averaged 5 to 5.5%, and that is elevated. I think that is something that is here to stay. If we have a big pandemic variant coming and slowing growth, of course, commodity prices will go down, and some of inflationary pressures will go down, but then new inflationary pressures could emerge. Things like supply side bottlenecks, disruptions that we saw for much of last year. So that could still push inflation up. So my sense is, with or without a new variant, inflation is likely to remain elevated. My sense is that between December this year and April next year, inflation will average very close to 6%, just under 6%. And I think that's a number which the central bank cannot ignore. The good news is that the central bank has already embarked on a policy normalization process without really calling it so. And I think that has been extremely smart. But I'm hoping that continues. I have a forecast of a 20 basis points reverse repo rate hike in the December policy meeting. I really hope that the RBI presses on with it and does not postpone it to next year.
What's the sequencing on the liquidity side to your mind? They've already stopped sort of injecting via GSAPs, etc. How quickly will they press the button on withdrawing and also on repo rate? When do we get to a sort of scenario where there's a hike in the actual sort of repo rate?
Yeah, so I think the favored sort of instruments for draining liquidity are, of course, the VRRRs and increasingly of higher tenors. And of course, they did away with GSAP. But my worry is that we are sort of looking at high liquidity of about 6 trillion for the next couple of years. It's not just like a couple of quarters phenomenon. And that's because you see the fiscal deficit is only coming down gradually. So the issuances of bonds will be high. Banks have invested a lot in GSECs in the last year or two. They may not have the same amount of appetite going forward. And at some point, the RBI will have to continue to play a role in the bond market, buying bonds and thereby infusing domestic liquidity. We also think that if something like bond inclusion happens next year, we'll see a lot of inflows into the economy. The RBI may have to buy dollars. Our sense is putting a lot of different moving parts together. Elevated liquidity is here to stay, and the RBI really needs to expand its toolkit. VRRRs, perhaps removing some of the caps on VRRRs to make them more effective. Over time, also trying out new instruments that it has, MSS bonds, the SDF window, more forward market intervention in the FX side. I think they'll have to use a lot of different tools to drain out the liquidity.
And repo is somewhere early next year. Potentially, you come around to a situation where you need to hike.
Our sense is that perhaps in the middle of 2022, around the June to August meeting is when we think the first repo rate hike will happen. So overall, we are expecting 50 bips of repo rate hike in 2022 and then 50 bips more in 2023.
That will still leave the repo rate at a very reasonable level compared to historical standards, but that's for another discussion. Perhaps, Pranjul, last question on what I've missed, risks that you're watching out for, apart from, of course, this variant, which is right now anybody's guess on how it plays out. Risks or upsides that could play out for the economy.
Yeah, look, the one risk that I always watch out for is what's happening at the bottom of the pyramid, for the simple reason that we don't have very good real-time data on this. We ignore it for the longest time until it shows up really glaringly on GDP. Asian countries in general did not increase social welfare spending through the pandemic as much as some of the developed economies did. So our bottom of the pyramid has been a little fragile, and we'll have to see how their fortunes play out. My hope is that there's a trickle down that is happening now, which will help them in terms of incomes and livelihoods. But if that fails, then we have a problem at hand, and that is something I'm tracking.
All right, Pranjul, I'll leave it at that. As always, thank you so much for your insights. Always great to speak to you. Thanks for joining us here.
Thank you, Hira.
Thanks so much.